Welcome back to today's lecture. In this lecture, we are going to continue with the costs of capital. If you have not subscribed to my channel, please subscribe for videos like this. If you are a returning subscriber, thank you for subscribing to this channel. So cost of capital. Cost of capital. In the last video, I did a question on the dividend valuation model and how to calculate the growth rates in dividend. Well, let me just do a quick summary of the cost of capital and what it entails. So from the introduction, I said cost of capital could either be the cost of debt capital or the cost of equity capital. So we have equity and debt capital. But for your exam purposes, I will bring in preference share. Preference share. So this is an hybrid cost of capital. So for cost of equity capital, you can use just two methods to calculate the cost of equity capital, which is the capital asset pricing model, CAPM, and also the dividend valuation model. So your cost of debt, you have two types of debt for your exam purpose also. Broadly, we have the irredeemable debts and the redeemable debts. Under the cost of equity, under your cost of equity, the dividend valuation model, you can further break it down into two using the growth model or without growth. So in the last lecture, I have covered the dividend valuation model with growth and without growth. In this lecture, I'll be taking the capital asset pricing model. So put together a company that has more than one source of debts. If, for instance, your cost of equity is 10%, cost of preference share, let's assume 18%, cost of debt, let's assume 20%. So if a company has this kind of capital structure, what will now be the company's cost of capital? What will be the company's cost of capital? So that takes us to the weighted average cost of capital. So you want to take the weight of the cost of equity, the weight of the cost of preference shares, and the weight of the cost of debt. And the weighted average cost of capital is just like an average of these three sources of financing a company. So, but in this class, we'll be looking at the capital asset pricing model. What is the capital asset pricing model all about? So the capital asset pricing model. So we've covered the dividend valuation model the last class. So in this class, I'll be teaching the capital asset pricing model. The capital asset pricing model is used to value capital assets or investments. It shows the relationship between risk and reward. So this model shows the relationship between risk and reward from an investment. So let me break that down. If I have two investments, investment A and investment B, and the risk for investment A is higher than the risk for investment B, let's assume that both investments gives a return of 10%, but the risk for investment A is higher than the risk for investment B. As a rational investor, I will not want to invest in investment A because it has the higher risk. Since both investment has the same return, I will invest in what? Investment B. The same return, lesser risk. But in reality, we assume that all investors are rational. If that is the case, that means nobody will invest in the investment with what? The higher risk. So to attract investment with higher risks tend to pay higher. So the returns on the investment with higher risks has to be higher than the return from the investment with what? A lower risk. So let's assume that this will pay 15% to compensate for the risk. So if investment A pays 15%, then it has compensated for the risk. So, but the level of risk will determine what? The return. So as the risk increases, the return also what? Increase in the same relationship. So the capital asset pricing model, unlike the dividend valuation model, factor the risk into what? The investments. Let me just say something about the systematic risk for completeness. So systematic risks, as the word implies, they are risks that affect what? The whole system. Be compensated for that risk. For instance, I've seen a company that's the management, they are not running the company very well. That's like an operational risk. And I decide to go and invest in that company because I feel that this investment is risky. You are not going to receive any reward for doing that. So you are going to be rewarded based on what? Systematic risk, not unsystematic risk. I hope you've gotten that. Okay. The measure of risk used in the CAPM, which is called beta. So the measure of risk that is used in the CAPM is called what? The beta. So it is the beta factor that will determine the level of risk in an investment. And it is that same beta factor that will determine what the return on a particular investment will be. In the market, company A and company B can be in the same market or in the same industry, but one will return 10%, while the other will return 15%. Business risk is the same. So why will this be happening? That means the beta factor for both companies are different. The risk that is in the two companies, specific risks now are different. So let's look at the beta factor. So what is the beta factor? Beta measures the systematic risk associated with a company's share. Okay. So take this systematic risk associated with a company's share. The market has a beta of 1. If the beta value of a company's share is 1, the systematic risk associated with the share is the same as what is in the market or the market as a whole. A company with a beta value greater than 1 has a systematic risk that is greater than the risk of the markets, and therefore that company's security will be volatile than the markets. When I'm using the word the markets, we are looking at the average from the markets. The return from a security will also be more than the return from the markets. For example, if the beta factor of a company is 1.2, so that one there signifies 100% for the markets. So if a company has a beta that is 1.2, it simply means that the company risk is 120%, which is 20% above the risk of the markets. So that means that company is expected to return, the returns from that company is expected to be what? 20% more than the return from the average security from the markets. Since the risk is 120%, we expect also the return to be in that same manner. Okay, so, but for a company that has a beta factor that is less than 1, it means that the company is less volatile than the market, and the company is expected to return what? Less than the market. So for instance, a company beta is 0.8 or 80%, while we say the market is always what? 100%. The market is always 1 or 100%. So the market is always 1 or 100%. That means this security will be returning 80% of what the average security in the market is expected to return. Okay. So what are the assumptions of the capital asset pricing model? Number 1 assumption, there are no transaction costs. So all these are assumptions. Basically, in your exam, there are things that you want to know or that you're supposed to know. Anytime you are using a model, try to know the limitations or the assumptions of that model and when is it appropriate to use that particular model to value your investments. So always know the assumptions of every model and the limitation, if there is any, of any model that you are using, because all your questions may not just be calculations. There are times that your examiner will want to test some of these assumptions. So the first assumption here is there are no transaction costs. So this is assumption 1, but in reality, there will always be transaction costs for buying and selling security. So the assumptions at times also serve as what? Limitations to that particular model. There are no taxes and inflation. So in your exam, if you like, you can break this point into 2. There are no taxes, no inflation. All investors are rational. So what does this mean? All investors are rational. As I explained earlier on, investment A, investment B. A rational investor will not invest money in this investment A if the return for both investment are the same, but the risk of A is higher. So a rational investor will not want to do that, right? So the rational investor will be looking at risk and what? Return. The higher the risk, the higher the return. So when the risk is high and the return is less, somebody that is thinking well will not want to invest in such an investment. So we are looking at it that all investors are what? They are risk averse. The next one is the markets are highly efficient. That is, information is available to all investors at low or no cost. Efficiency in the market. So whatever the share price is, if the share price is 20 naira, for instance, we assume that the market is efficient. That the interaction between demand and supply is what is determining the share price. So the shares are not overvalued or what? Undervalued due to what? The efficiency of the markets. So in a subsequent lecture, we teaching you the efficient market hypothesis. But for now, just understand that the efficiency of the market means that informations are available. Therefore, nobody has the capacity to influence the share price, just the way you think about the perfect market. So that's the way you also think about what an efficient market. So there's just one risk-free rate of either lending or borrowing in the economy. For instance, now in the Nigerian economy, the government rates, we assume that the government bonds are what? They are risk-free. So if the central bank has set the borrowing rate or the MPR to be 12%, we assume that every company in the economy can borrow, or every investor can borrow at what? Just one rate, okay? But in reality, it is not so. All investors cannot borrow at the same rates. The next assumption is that beta coefficient is the only measure of risk. Beta coefficient is the only measure of risk. There is perfect competition and no single investor can influence prices. And the last assumption is all investment decisions are taken within a single time horizon. All investment decisions are taken within a single time horizon. So the risk-free rate in practice, or the government rate, changes from one period to another. So we are assuming that all these investments that we are looking at, they are going to be taken or undertaken within a particular period where all these other variables will be what? Constant. So what does the formula look like? So this is the formula for calculating the cost of equity using the capital asset pricing model. Cost of equity equal risk-free rates plus beta into RM, which is return from the markets, and RF, which is the risk-free rates. So the return from the market is basically average returns from the market, as I said earlier. Like for the US, we have the S&P 500, which is like one of the indicators in the markets. Now, let's look at this formula. Let's break the formula down into bits. So the KE is the cost of equity. The RF is the risk-free rates. Beta is the coefficient of the beta coefficient of the security is the beta here. RM is the average return from the market. So this beta into RM minus RF is known as the risk premium. This is the return. So if I have my risk-free rates, let me explain it here. Risk-free rates plus beta into RM minus RF. Okay. So this risk-free rate is your government rates. So if government bonds are paying 5% and the government's security is risk-free, right? We say the higher the risk, the higher what's the return. So for me as an investor, I will not want to invest in security, which is shares, because if the share is going to also pay me what 5%, I won't invest in that share because I am very certain about the government's bond that at the end of every year or whatever the interval is, I'm going to receive my 5%. Therefore, buying bonds from the government is much more secured than investing in shares. So for me to invest in shares, there must be risk premium, a premium like higher return for investing in the share market. If not, it's better for me to invest in the bond. So this is the risk premium for investing in a particular company's security. So this is the risk premium for investing in a particular company security. Say company ABC. I want to invest in maybe any of these multinational company or whatever the company is. For me to invest in that company, I must be able to have this. Are we together? So now, that is the risk premium for investing in a specific company. When I start solving it, you understand it better. Now, in that same formula, we also now have the RM minus RF. So the RM minus RF is the risk premium for investing in what? In the market. So it is called the market risk premium. So this is the market risk premium. So for me to invest in the market, then this must be in place. I must have a higher return. Okay. So let's scroll down a little. So types of risks. We have the systematic risk and the unsystematic risk. So as I said earlier on, the systematic risks, they are the risks that affect the whole market. Every company in the market is being faced by that risk. So systematic risks can also be called unavoidable risks, undiversifiable risks, or market risk. Systematic risk arises because of factors that affect the whole markets. These factors include government regulation, recession, changes in interest rates, political instability. All of these factors put together, every company that operates in the market face one of or more of these risks. So it is not a risk that you can avoid so long as you are in the stock markets. So it is called what? Systematic risk. For the unsystematic risks, this refers to risks that are avoidable. They are not risks that are shared across the industry. It's risks that is avoidable, a risk that the company can avoid. So they are also called specific risks or what? Avoidable risks or diversifiable risks. Unsystematic risks are often specific to an individual company due to their management, financial obligation, or location. So unsystematic risks, they are not risks that is spread across the markets. They are risks that are specific to a particular company. Okay. Unsystematic risks, this type of risk is specific to a particular company and it can be avoided through diversification. A company can avoid this kind of risk by investing in many different securities. Okay, unsystematic risks include, let's look at the types of unsystematic risks. They include financial risk. This is the risk associated with the way a company is financed. Financial risk arises because of what? Financial leverage. So the moment you borrow money, financial risk increases. The moment you borrow, financial risk increases. We have legal risk, we have a reputation risk, operational risk. All of these put together are known as types of unsystematic risk. In summary, unsystematic risk is solely associated with a specific company or industry. Unsystematic risk can be reduced through diversification. Sources of unsystematic risk include business and financial risk. The total risk of an investment or a portfolio consists of unsystematic risk and systematic risk, those that affect the whole company in the given markets. So what is the implication of the capital asset pricing model? What is the implication of this model? Investors will not be rewarded for unsystematic risk because it can be avoided. Therefore, the required rate of return on investments should be based on the systematic risk of that investment. Individual investor can reduce their total risks by diversification. So let's look at this example. XYZ PLC has a beta of 1.2. So this 1.2 is the measure of risk. Used to measure the risk, which is the beta factor. The risk-free rate is 4%, and the return from the market is 9%. Calculates the company's cost of equity. So this is the formula. Cost of equity equal to the risk-free rate plus the beta into the return from the market and also minus the risk-free rates. So that takes us to 4 plus 1.2 into return from the market is 9 minus the risk-free rate, which is 4. This becomes 4 plus 6, that's 10%. So your cost of equity, therefore, is what? 10% using the capital asset pricing model. So in your exam, the examiner may give you a question and wants you to calculate the cost of equity. It is whatever you see will determine which method you are going to use to calculate the cost of equity. So the moment I see beta and I see risk-free rates, then it means that I'm going to be using what? The capital asset pricing model to do that calculation. Okay, but so the moment I'm seeing something like dividend, it means that I'm going to be using what? The dividend valuation model to calculate the cost of equity capital. Second simple example. ABC has an equity beta of 1.2. The risk-free rate is 4%, and the market risk premium is 5%. Calculate the cost of equity. So if you look at this question, here we are given the beta. We are given beta here. This is the risk-free rate, RF. In the last example, we're given RM, which is the market return. But in this example, we are not giving RM, but rather we are giving what? The market risk premium. So we are giving the market risk premium. And the market risk premium is RM minus RF. So this is the market risk premium. So since we are giving the market risk premium, we are not going to be doing RM minus RF. To just be your RF, which is 4%, plus the beta, which is 1.2. So you have been given RM minus RF to be what? 5%. So you just bring that in here. RM minus RF has been given. So into what? 5. So you are not doing 5 minus 4. Okay, I hope that is understood. So your final answer will be 10%. Let's look at the security market line. What is the security market line? Security market line is the representation of the capital asset pricing model. It shows the relationship between the expected rate of return on an individual security and systematic risk that is non-diversifiable risk. It shows the relationship between expected rate of return of an individual security and systematic risk. Okay, so this is just like a repetition of the capital asset pricing model. It's just like a repetition of that formula, which is KE into RF plus B, RM minus RF. So that is the security market line. So that's just the formula. But this is the diagram. This is the diagram of the security market line. So this line here is the security market line. This is the security market line. So it helps an investor. So the risk-free rate is not always zero, begins above zero. And we assume that the cost of equity will always be falling on what? This line, which is the security market line, right? To always be falling on this line. Okay. So let me assume that this is zero. So this is where your risk is, which is the systematic risk. And this is your return. This is the returns. So when risk is zero, just like the question we saw, the risk-free rate was given to be 4%. So at zero risk, the return should be what? 4%. So if the cost of equity, for instance, for any reason is what? Let's say 10. So we assume maybe this is zero. Sorry, your beta. This should be your risk, which is your beta. Let me take that off. Okay. This is zero risk. So let's assume that your beta is 0.5. Your beta is 0. Or let me make this 1.0. Your beta is 1.5. So this is 4%. Let's assume this to be 8%. I'm not using a graph anyway. So, but just for you to get an understanding of what this line represents. So, but if you are using a graph, it's going to give you a perfect result. So let's assume this is 8%. Let me take this off. And let's assume that the next one is 10%. So based on this, we are saying that if I drag this 8% down here, that's at 8%, at 1.0 risk, the return should be what? 8%. So at 1.5, if I take this up, I'm expecting that my return should be what? 10%. So if you look at it, the higher the risk, at zero, the risk-free rate return was 4%. If it moves, as it keeps moving higher, the return also keep what? Moving higher. So, but we are expecting that for security that are well priced, the return will be on what? On the security market line. So if a security is well priced, the return will be what? On the security market line. So if I drag this line here and bring it here, it means that the return should be what? 8%. At 1.5 risk also, if I drag the security market line here, I'm assuming that the return also should be what? 10%. But if the security is not properly priced, the security may either fall, the return on security may either fall below the security market line or above the security market line. So at 1.0, right, the return is supposed to be 10%. But if it falls below 10% or above 10% at this 1.0, it means that the security is not properly priced according to the asset pricing model. So all security is, returns from security should fall on what? The security market line. Just as I've drawn the graph to say if this is a 1.5, we expect 10% return. So, but if it is 1.5 and I'm getting 15% return, or I'm getting 8% return, it means that that security is either overvalued or what? Undervalued. So let's look now at the concept now of overvaluation of stock and undervaluation of what? Security. Let's look at what that means. So stock that are above the security market line are undervalued. More should be purchased. So based on this, more should be purchased. Stock that lies below the security market line are overvalued. and should be sold. Okay, so let me still use this as an example before I solve a question so that you can understand the basics. So this is the security market line. I assume that this was 4% and this is 0% risk. So I also assume 8 and 10. So if I bring in this to say 0.5, let me leave it the way it was before. And I bring it to say this is 1.0 and this to say this is 1.5 beta factor. So as at this point, I'm expecting the returns to be what? Let me just say approximately 8%. At this point, I'm expecting the return to be, say, maybe 9%. And at this point, I'm expecting the return to be, say, 10%. Okay. So if the beta factor is 1.5, while I invest, I've done an evaluation to say, okay, this stock that I want to invest in, at the end of the day, the actual return that I should be getting should be what? 10%. So based on that, I invested in the stock. But the actual return that came is not 10%. The actual return that came is what? Is now maybe 9%. This particular stock now returns 9%. So this is where the return is. It's below the security market line. That means it has returned less than what I was expecting. So it means that that security is not a good security, that I overvalued the security. Therefore, I should sell it. Okay, so we say stocks that are below the security market line are what? Overvalued and should be sold. Okay, but now let's assume that before I made the investments, the beta factor is 1.5, and I'm expecting that I'm going to get what? 10%. But at the end of the day, what I got is above 10%, let's say somewhere here, 12%, for instance. It means that that security is a good security, that I should buy more of that what? Security. That means when I value the security, I was saying it will give me 10%. It means that I undervalue the security because now it's giving me what? 12%. So I undervalued it. And as a result, I should buy more of that security. Okay. So let's look at the alpha factor. We say beta is used to measure what? Risk. So what about the alpha? So alpha is used to measure excess return on security. The alpha can be positive when stock is undervalued. It lies above the security market line, or negative when the stock is what? Overvalued. So let's look at that. The alpha becomes 0 the alpha becomes 0 when stock fall directly on the security market line. So that means they are properly valued. It will be positive if stock are undervalued, or negative if stock are overvalued. But it will become 0 if the stock is what? Properly priced. Based on some theories, it is expected that if a firm generates return in excess of the cost of capital, it will attract competition and competitors will enter into the markets. Eventually, the return will decline. And as a result, the market, which is the force of demand and supply, will definitely eliminate that excess return. And over time, the stock will be properly priced. So, example, So in this question now here, we have three different investments, stock A, B, and C. The expected returns from these investments. So I can call this in your exam. Anytime you see something like this, just make it easy for yourself. You can just look at this at what as the actual return. Okay, so that you get to understand the interpretation. 14.5%, 7 and 9%. So look at the beta factor, the one with the higher expected return, the beta is 1.1. The one with 7% return, the beta is less, means that it's less risky. And the one with 9%, the beta is what? 7%. So the beta and the return are commensurates. Market index, 10%. So this market index is the return on the market. And the risk-free rate here is what? 6%. Okay, so what is the requirement? Calculate the required rate of return for each of the three securities. That's A. The B part of it says, which of the security is overvalued or undervalued? Let's look at the A part before going to the B part. So this is the formula for the calculation. Cost of equity equal the risk-free rate, the beta factor, into the RM and the RF. So in this question, do we have the risk-free rate? Yes, the risk-free rate is 6%. And this risk-free rate applies to all security in the markets, all companies in the markets. So we're assuming that this is company A, B, and C, or the stock of company A, B, and C. So the risk-free rate, which is 6%, applies to all security in the markets. Okay, so now the second thing is what? The beta. The beta for company A is different from B and also C. Okay, now it is this beta that we end up determining what the return on these investments will be. So we now have also RM minus RF, which is the premium, the market risk premium. In this example, the market risk premium is 10 minus 6. So the market risk premium in this example will be what? 4%. Okay, so let's go down to the solution. So from the formula of the security market line, we have your Y is equal to A plus BX, which is just your BX now is the beta into RM minus RF. So, but what is RM minus RF, which is the risk premium? 10 minus 4, which is what I explained earlier. So, for security A, the beta factor is 1.1. So 6 plus 1.1 times 4 will give us what? 4.4, and the costs of equity or the return to the investors will be 10.4%. Okay, see the higher risk here, but for security B, it's what? 7.6. So what is the difference? The difference is what? The beta factor, which for security A is 1.1, and for security B is what? 0.4. So with a lower risk, the return became what? 7.6 lower return, while this was what? 10.4%. So for security C, Still the same thing. 6 plus the risk is 0.7, while the 0.7 times 4 give you 2.8. The return becomes what? 8.8 for security C. So now, how do you know if a security has been overvalued or the security is undervalued? Okay, so let's scroll down back to the question. These are the expected returns from the security. These are the expected returns from the security. Okay, this is what you are expecting, right? Or the expected actual. As I said, always use actual so that it will give you a guide. Okay, but now for security A, what did we calculate using the model? What did we calculate using the model? Is it the same thing as this? So if what we calculated using the model is also 14.5, it means the security is properly priced and the security lies on the capital asset pricing model line. The the security market line. If it is well priced, it will fall on the security market line. But if it is lower than this or higher than this, it means the security has either been overpriced or underpriced, or overvalued or undervalued. So we have 14.5, 7, and 9. Those are the expected returns from the three securities. But let's see what the model, what we calculated using the capital asset pricing model. So this is the alpha table. So this is the alpha table. Expected return, the required return. For security A, the expected return, let me cancel this. So let me know if, okay, let me still leave it. Let me leave it. I want to test your understanding of what I'm going to do. So let me hide the solution. So I want you to tell me the security that is overpriced and the security that is undervalued based on this scenario. Okay, so expected actual 14.5. But this is what you require the security to give you, right? This is what you require the security to give you, 10.4. Okay. So let me assume, because before you invest, you want to check to know if the investment is viable. So let me assume the model that you are using to check if the investment is viable is what? The capital asset pricing model. Okay, so you have used the capital asset pricing model to check security A, and the model has told you that this security, based on the risk, should return 10.4% to you based on the risk. But at the end of the day, the security is returning 14.5. What does it mean? There is a difference of what? 4.1. So this security now, is it a good business or a bad business? Is it undervalued or overvalued? We say security that are undervalued, they are what? Good business, because their returns tend to be more than what you expect. So let me give you 2 minutes to fill in the value here. Is it overvalued or undervalued, overvalued or undervalued? So let me see if you are going to get it. All right. I assume you got it. So for security A, the valuation is what? 10.4, based on what? The capital asset pricing model. So this module has undervalued the return, but the return actual return is what? This. So based on my module, I've undervalued the security. So this is undervalued. So if security is undervalued, what do? You buy or you sell more. If it's undervalued, it means that you should do what? Buy more of that security. So the one with positive alpha is what? Good. It's a good business, undervalued. The one with negative alpha is what? Overvalued. So it means that from my calculation using the CAPM, I'm saying that this security should be giving me 7.6, but actually the security has returned what? 7%. So that means it's lower than what I expected. And that means I have overvalued this security. I've overvalued it. I'm thinking it will be giving me what? 7.6 based on my valuation, but it's not giving me what? 7. I've overvalued it. So I have to sell this security and use the money to buy one of either A or B. Okay. So this interpretation here is the same with the interpretation for A, undervalued. So buy. So that's just the solution to that. But let's look at the footnotes. From the alpha table, it can be seen that security B is overvalued and should be sold. Security A and C are undervalued as they both have positive alpha. Therefore, more of the two security should be bought. Better measures the volatility of a stock add to a diversified portfolio. Okay, so I want you to take note of this line here. So the beta is basically used to, if you have a portfolio, you want to check the riskiness of each of these portfolio. So in the question, we're giving beta for stock A, B, and C. So that beta measured the volatility in each of these security, okay? But the standard deviation, on the other hand, is used to measure what? The volatility. Let me take this off so that you see what I'm reading. Okay. So the standard deviation, on the other hand, measures the volatility of the stock if the so the standard deviation measures volatility of a stock if the stock is the only stock you have in your portfolio. So it measures the total risk of that stock. So it is basically used for an investor that has just one stock because the stock has not been diversified, right? We said for an investor that has more than one stock or one share or one investment, risk has been what? Diversified to eliminate unsystematic risk. So that investor is not faced with what? The systematic risk because what? The investor has diversified his or her investment. But for an investor that has just only one security, that means it is undiversified. That means that investments will be measured using what? The standard deviation. So beta is more important if you plan to hold a diversified portfolio, while the standard deviation is more important if you plan to put all your wealth in one stock. In some exam question, your examiner may not give you the beta factor, but you'll be given information that you can use to calculate the beta factor. if that is the case, you will need to calculate the beta factor before you can solve the capital asset pricing model. Now, this is the Formula 1. Depending on the information or the data you are given, that will determine whether you are using Formula 1 or Formula 2. So if you are given covariance of the security with markets and variance of the security with markets, that means you are using Formula 1. Okay, so now there are times your examiner, anytime you see covariance, anytime you see this word covariance, just know that it is Formula 1 you are going to be using. So sometimes the examiner will give you the covariance and what? Standard deviation. So if your examiner give you covariance and standard deviation, there's no way you can use Formula 2. So you have to convert the standard deviation to what? To variance and use what? Formula 1. So the formula is simple. The numerator, if the numerator is covariance, you know that the denominator will be what? Variance. Okay, that's for Formula 1. Anytime you see covariance, you know that you are using it with what? Variance. That's for the Formula 1. Then for the Formula 2, the examiner may decide to give you the correlation with what? Markets. So your examiner may also give you correlation with markets and standard deviation of security. The moment this is what is really this numerator is basically what will determine the formula that you are using or that you'll be using. Okay, so the moment you see this and this, even if your examiner did not give you standard deviation of markets, your examiner decided to give you the variance of the markets, it means that you are going to convert this variance to what? Standard deviation. Okay, so that's how to calculate the variance using the formula. So in my next class, I will be taking some other parts of what's cost of capital. But basically, I will solve a question on this. Thank you for watching. Please subscribe to my channel, like my videos, and also comment on the comment section.